Hey guys, how's it going? This is Alex, and I want to thank you for joining me on this personal finance tutorial. This is the money management series, and this is the money management overview, your actionable guide to managing your money. So let's start off with what I want you guys to take away from this video. The first thing I want you to take away is the questions that you need to be able to answer in order to effectively manage money. I want you to know that it's your fault. Well, not really, but we'll get into that. And that there's a balance between behavior or behavioral economics and money management. But before we start, disclaimer. The financial information in this video is for informational purposes only and not for the purpose of providing specific financial advice. Sorry about that, guys. You should contact a financial advisor to obtain specific financial advice. Okay, so let's start off with personal finance. So in personal finance, there are four areas that constitute the foundation, and they are behavioral economics, risk management, money management, and debt management. So the definition of personal finance is the management of capital resources by an individual, couple, and or household in accomplishing immediate, short-term, and intermediate and long-term goals. So the term is probably the most confusing thing here. Think of immediate as expenses or anything happen on the reoccurring basis. Short-term is anything that would take 1 to 5 years to complete. Intermediate is anything that would take 5 to 10 years to complete. And long-term would be anything that would take 10 or more years to complete. Okay, so the goal in personal finance is actually the following. To first manage money in order to generate a surplus. Once you have the surplus, to invest that surplus to create income. Now we move on to risk management. So risk management is the analysis, implementation, and monitoring of a plan or plans to eliminate or at least minimize loss from uncertain outcomes. So think about the future for a second. So at the end of the day, we don't know what will or won't happen to us with 100% certainty. So the goal in risk management is to eliminate whatever risk we can. But for the ones that we can't completely get rid of, we can at least reduce their negative effects. So there's going to be a debt management series as well. There's going to be a playlist. I'm gonna put it in the description below. It's going to cover different things like insurance coverage, probability and statistics, worst case versus worst practical case. Yeah, I know, really fun stuff, right? But it's actually going to have a lot of really important things for you guys to use in personal finance. Moving on, we have debt management. So debt management is the analysis, implementation, and monitoring of all plans to eliminate, settle, or make current all prior financial obligations. So as far as what I'm saying with a financial obligations, you can think of it kind of like this. If you have an account in collections, that needs to be settled. If you have an account like a car loan or a car note, those need to be eliminated. And if you have a credit card with late or missed payments, those accounts need to be made current. So there is also a there's also a debt management series. In the debt management series, we're going to cover a lot of different things, such as different types of debt management strategies, statute of limitation, Fair Credit Reporting Act, Fair Debt Collection Act, and general credit repair. And that's going to be in the description below as well. Moving on to behavioral economics. So behavioral economics is the temperament, psychology, and habits of an individual, couple, and or household when interacting with their personal finance. So just to break that down a little, all it really means is how do you think about wealth and money, and how do you behave when interacting with money? So I have a quote here. This one is from Dave Ramsey. So Dave Ramsey said it best. He says success in personal finance is 80% behavior and 20% head knowledge. So using that for what I'm going to say next, if you're not seeing success with money, it has more to do with how you think about money and how you behave when handling money than whatever plan you actually have. Another one is from Tony Robbins. So Tony Robbins says money is a game. Either you master it or on some level it masters you. And this is from his book, Money Master the Game. Honestly, it's probably one of my top 3 favorite books on personal finance. Now, there's also going to be a behavioral economics series, and that one's going to cover things like the psychology of money, money archetypes, money blueprints, cognitive biases. I have mental biases, but essentially it's the same thing, and that's going to have the link to the description below. Now moving on to money management. So money management is what you're here for. This is the analysis, implementation, and monitoring of all plans to accomplish goals with current capital resources. So I want you to think about a budget. Now, what most people do is they focus on a budget and nothing else. And the budget is just the first step, and it's not the most important. And we're going to get into a lot of different things that concern that. The first thing I want to introduce to you is the 4 questions that you need to be able to answer in order to effectively manage money. The first one is, how much money do I have coming in? Income. How much money do I have going out? Expenses. How much do I have in debt? Credit cards, student loans, mortgages, car loans, and the like. And how much do I have in savings? This is anything that's in a emergency fund or any liquid assets. Liquid assets are essentially anything that may not actually be cash, but can be converted to cash in a short amount of time. So if you have a stock in Microsoft and you decide to liquidate your stock and use the cash for something else, that's a really good example of a liquid asset. Moving on, I actually want to introduce something that I got from Robert Kiyosaki in the Cash Flow Quadrant. So in 1998, Robert Kiyosaki, more famously known as the author of Rich Dad Poor Dad, released a book called The Cash Flow Quadrant. And this one outlines the 4 kind of individuals that exist in the world of money. So you have four ways of generating income. The first is the employee. The employee is someone who has an employer and has a job. Often they trade their time and effort for money. The second one is the self-employed. That's the bottom left, and the self-employed are often very skilled individuals, and they trade their talents and skills for money. Now, a self-employed person could also be someone who has a small business meaning less than 500 employees and less than an annual revenue of $10 million per year. Now, the main issue with the self-employed is if they were to step away from their business, it would stop, and then they would no longer be able to make money. The top right is the B quadrant for the big business owner, and these individuals have employees, and they have a system. They have their employees working the system, generating the money for them. The main difference between the S and the B is the fact that they have over 500 employees and they have over $10 million of revenue, and they can step away from the business for a year or more and have it running just as well, if not better, than when they were actively involved. And the last one is the investor, and these are individuals that have their money working for them. They don't have to work for the money, but they can if they like. Moving on, I want to talk to you guys about income allocation. So this is the ideal income allocation for anybody who's looking to manage their money. And the way that it works is you have the expenditure categories, and they are as follows. The first one is housing. Housing should account for 30% of income. The next one is expenses. Expenses. It's other necessary expenses that aren't quite housing, but things that you still need to buy. So groceries and that kind of stuff. And that should account for another 30%. The next one is leisure or guilt-free spending, and this is pretty much spending on whatever you want without guilt, and that should account for 10%. You have debt service, which accounts for 20%, and you can think of debt service as the minimum amount due to keep a debt account current. So if you have a credit card that has a $25 minimum payment, then your debt service for your credit card is $25 per month. And the last one is saving/investing. So now I want to show you exactly how this works. So what we have now is an income target scenario. So we have a business manager that lives over in New York City. What we're going to say is the rent of this business manager is going to be $1,500 per month. And we're going to say that all other necessary expenses are going to be another $1,500. So given the two expenditure categories that we have a total of $3,000 per month. So if we take the expenditure categories and their percentage, then we have housing for 30% and other necessary expenses for another 30%. So the total expenditures that we have are 60% of income. So if $3,000 has to account for 60% of your income, then your target income should be $5,000. And essentially, that's exactly how it works. It's very simple, and it gives you a logical and rational framework to work from, rather than just kind of snowballing and guessing whatever it is. Now, the general purpose in money management is to move from wherever you are ultimately to the I quadrant and to find your path to become an investor. Now, there's multiple paths, and I actually have an investor 101 course right at the end of the series. So definitely check that out. And if you're not too sure exactly what I mean here, that is going to illuminate a lot of what I'm talking about and what I just said. The next one is to effectively analyze financial decisions. So what I just showed you guys before with the business manager, it can now show the business manager how much money that he needs without putting in too much more thought than he already did. And the last one is to monitor all aspects of your financial life. Now, this money management series is actually just the basic. So a lot of the stuff that you're going to see here are foundational, but you may see that I don't have anything for, let's say, an emergency fund, retirement, and estate planning, and that's because those are more advanced. And what I find is what you need to do is you need to focus on the stuff that I'm talking about here. Once you get those down packed, then you can move on to something else, and that's ultimately what I'm going to do with the money management series. So now what you guys are probably wondering is, where do I fit into this? I mean, meaning me, not you. Okay, so what I want you to do is I want you to think of me as your guide to personal finance. I'm going to provide you tutorials to educate you on an otherwise confusing subject, and I'm going to provide content that you can use immediately after every video. So the first thing that I want to talk to you guys about is the money manager's process. And this is the process that you have to undergo in order to manage money. Now, the 0th step is to gather financial information. And that sounds exactly what I put down. Just gathering the information that you need to in order to effectively analyze your financial status, or your stature with your personal finance. The next one is to create a budget. Now, I said when I gave you the definition of money management that the budget is the first step and it's not the most important. And that is vital. And what you're going to see is everything below this is actually more important than just the budget that you create. So the second step is to establish goals and aspirations. And I have think big, act small. So lose any limitations or any limited beliefs you have when you're creating your goals. And then act small. It just means to take small, deliberate steps towards getting to those big goals. The next one is to evaluate information and budget versus goals. Okay, step 4 is to make necessary adjustments. Step 5 is to automate the system as much as humanly possible, taking out the human factor. The human factor is you. And the last part is the most vital one. This is actually the most important one, and it's the one that is the easiest to is the easiest one to mess up, and that is to stay motivated. And that is making sure that you stay on track towards getting your goals. So now I'm going to talk to you guys about budgets for a second. And no, I didn't stutter. I'm telling you, budgets suck. And you may be saying to yourself, wait, Alex, I thought you just said that you were supposed to teach me about personal finance, and you just kind of slammed the only thing that I know about personal finance. And that's actually for a really good reason. Like I said before, it's not the most important thing. And also, I read a book, and in the book it says a lot of the reason why you're struggling with finance is because of how you're thinking about a budget. By saying budgets suck, this actually cleans you from a lot of the negative aspects of a budget, because even if you do confirm to a budget, if you have a negative belief about budgets or an underlying negative belief about budgets, it's never going to work. So what I want you guys to do, if you're not in the middle of a library and someone's going to look at you like you're crazy, is I want you to pause the video right here and say 3 times out loud, budgets suck. Go ahead. I'll wait. Okay. So now I'm going to assume that you're back. And we're going to talk about the different things that we're going to estimate, which is exactly what budgeting is. It's just creating estimates. And that's income, expense, your debt service, and your savings. So I want to talk to you about the most common problems and mistakes that people make when they're making a budget. The first one is not adjusting for fluctuations. Now, listen, you probably already know that your income may vary from month to month. And in some cases, it could even vary from paycheck to paycheck. And what's most important there is to understand that you need to be able to make a budget that's not so rigid that you can go with the flow, and you have some sort of idea of what to do if it's not exact. The second one is a tool for inaction. So tool for inaction is something that I'm coining for any time someone sees their budget and then they suddenly just get sad and then decide to end the process here. And understand the reason why you're creating a budget is you're trying to figure out where the problem is with your finances. So if you see that your budget is below your expenses, it's not something that you should be getting upset about and then turning around and doing nothing. No, what you need to do is you know where the problem is, and you know what you have to do. You need to increase income or decrease expense. There's a number of things that you can do, and there's an income accelerator. That is actually one of the parts of the money management series, and I'm going to say look into that one. The next one is using the average versus standard deviation. So if you know anything about the process that I'm going to take you through. The process that I'm going to take you through is going to use standard deviation information versus averages. Now, what you may notice is with averages, sometimes what they'll do is you'll have an average, and then you'll have a buffer, maybe of 15% or something like that. And the truth is, that only works if you're if your paycheck only varies from 15% or more. So if your paycheck, if it if it fluctuates a lot, using standard deviation can help you address this issue. Okay, so moving on to the next one. The next one is using as an end all be all. So that actually goes back to what I was saying before about using it rigidly. And what you have to understand is you're using it to check your financial status and how much money you have. You're not supposed to use it as, oh, this is my budget and I'm going to stick to it, because your budget may actually be very bad. So you need to give yourself a little fluctuation. It ties into pretty much everything that I said before. And the last step is ending the process at budgeting. Remember what I said before. Budgeting is only step one. All right, guys, so that's all the new information that I'm going to provide you in this video. So in the next video, you're going to see a lot of stuff about budgeting and setting goals and evaluating those goals. We're going to have income and expense targeting scenarios, and we're actually going to go into income, all your other expenses and expenditure categories, debt, and savings. So before I get out of here, I've recommended book lists. Everything that you see here is going to be in the description below. I definitely would recommend you guys go into those. If you guys want to read those books, get them off of Amazon through the link. That really does help me out, and I would really appreciate it if you actually do it. That's actually my affiliate links. So the first one you see is The Richest Man in Babylon by George S. Clason. That one to me is kind of like the personal finance Bible, the Bible to personal finance. Read that 5 times. It's pretty cheap. I'm pretty sure the link that I have there, unless they change the price, it should be no more than $3 for any media type. So definitely check that out. The next one is Rich Dad Poor Dad by Robert Kiyosaki, and you heard me bring that up earlier. Definitely a great book on personal finance. I do recommend that. The next one is Trump University Wealth Building 101 by Donald Trump. Now, I know a lot of you guys out there may have some problem with a lot of the media that you're hearing about Trump, and what I want to tell you is please don't bite my head off here. This book is actually tremendously good, and it's one of the best things that I could find on personal finance. Now, as far as Trump University, you guys may have heard it's referred to as a scam, and that actually is a lot of misinformation too. Trump University, the Attorney General of New York did not want a for-profit business bearing the name of university when they're not a chartered school. That was the issue that the Attorney General had with Trump University. And I know there was a lot of hang up with some of the seminars. I cannot speak on the seminars. I never attended one, but I can tell you that I've read a lot of the Trump University books, and all of them that I've read were actually really good content. So I'm going to recommend you read that 5 times. But I'm going to leave that up to you. I know you guys might have some hang up about Donald Trump. But the next one is Money Master the Game, and you heard me bring this up in before. This is definitely one of my top 3 favorite books on personal finance. The next one is The Millionaire Next Door by Thomas J. Stanley, PhD, and him and William Danko do a tremendous job of explaining probability of success becoming a millionaire. Definitely recommend you take a look at that. So on the fifth money manager process step, I told you about automating the process. The Automatic Billionaire by David Bach. This actually tackles it. So I definitely recommend you guys read that about 5 times as well. But wait, there's more. So this one, Money Management Skills, narrated by Professor Michael Finke by The Great Courses. If you guys don't read or or take any of the other contents, definitely take this one by the great courses. This one actually has a lot of really good information about personal finance and money management. So I'm definitely going to recommend you guys go through the course 5 times. The next one is Become Your Own Banker by Nelson Nash. And this one is actually talking about thinking about personal finance the same way that a banker would. And he does talk about dividend paying whole life insurance policies. I'm leaving out my opinion on using those as a vehicle. But what I will say is a lot of the paradigm information that he uses in the book, it's really good information. So I'm going to recommend you read that about 5 times. The No BS Guide to Wealth Attraction by Dan Kennedy. So if you ever read any of the No BS books, you already know he is extremely blunt. And I'm going to recommend you read that five times as well. The next one is Think and Grow Rich by Napoleon Hill. Read that about 5 times. The Cash Flow Quadrant, which I've also brought up before, and that is by Robert T. Kiyosaki. Read that 5 times. And the last one is the 10X Rule by Grant Cardone, and that is about goals. So if you remember step 3 about goals, essentially what the 10X Rule does is it takes essentially what Grant Cardone says is if you have a goal and you're not you're not about to achieve it, rather than lowering your target, increase your effort to achieve the target. And that's one of the things that he talks about in this book. Great book. I'm going to recommend you read that 5 times as well. All right, guys, and what you're going to see here is this is the money management series basic overview. So the foundational stuff for money management are all here. So what you guys see, that's everything that I'm going to be covering in this series. So I want to thank you guys. I know this was a lot of information. I thank you for staying with me. If you like this video, hit the thumbs up. Leave a comment and tell me what your view on budgets are. And you heard my view on budgets, so I want to hear yours. Can't be worse than mine. So tell me what you guys think about budgets. And the next one is, if you like this tutorial and you want more, then subscribe to the channel and you receive notifications anytime I upload new ones. So I want to thank you guys for joining me on this again. And this is Alex, and I'll see you on the next video.